I think 2018 is a year that investors globally are going to be willing to forget, as it produced negative returns not only across global equity markets but across most asset classes. Within the year, though, I think there was two distinct cycles, or a tale of two different markets, that pre-September and then post-September. Pre-September, or the beginning of the year, we came out and there was a recession scare. We had a significant drawdown in the market, which abated pretty quickly. As growth stocks resumed taking leadership role and taking markets into new highs into September, the S&P 500 achieved a new high. The leadership was, as I say, tech stocks, primarily what are affectionately known as the FANGs: Facebook, Apple, Amazon, Netflix, and Google. Oil, which had started the year below $60 a barrel, traded up into the high 70s, 76, I think, $76.50. And the tone of the market was reasonably positive based on earnings coming through from the tax relief package from the Trump administration, certainly having very positive impact on earnings. September changed all that. In September, we got a big resumption in volatility, and concerns changed to focusing on three specific things. Interest rates, the direction of, and would the Fed create a policy mistake by raising interest rates? Global trade, and particularly trade with China, and all the political rhetoric that was bouncing around that, and certainly what was the recession risk, and were we close to a recession? Those concerns manifested themselves into a significant downdraft in global equities, with the S&P 500 by year-end having about over 50% of its constituents producing a negative rate of return. Somewhere just under 75%, I believe, of Canadian equities producing a negative rate of return. But underneath all that were reasonably positive economics. So we can start with the price of oil, obviously. Canadian equity market is very, very narrow. It's not broadly diversified and is very, very dependent on three constituents, basically: energy, materials, and financials. Energy, the price of oil, as I had evidenced earlier, peaked at $75 in September. It's down 40% by the end of the year. So that had a significant effect on what happened to the Canadian market. The energy complex, the energy sector in US and Canada is the worst performing sector within those markets. That taken with financials, rising interest rate environment punished the financials as well. And materials, as I said, most asset classes produce negative rates of return. So rates are rising because, as I said, the economic data continues to suggest that the economies are in reasonably good shape. Inflation is at the margin increasing and has been for the last 2 years. So central bankers globally are out there starting to remove stimulus, raise rates, not wanting to get behind the curve. So that is very, very important. But it does set up questions about the future, about, quote, a policy mistake, that they choke off any growth that might be out there in the future. And secondly, at what point does it become more attractive to become a fixed income investor as opposed to an equity investor on a risk-adjusted basis? But I think we're a long ways from that. The backdrop is still that the economy is in reasonably good shape. So when we look at leading indicators, or I mentioned the ISM or unemployment rates, certainly in North America and on a global context as well, a recession is out there. But we don't believe it's as near as many are pontificating on it at this point in time. So I think volatility will be a feature going forward. I think earnings growth will slow. The benefit of the tax cuts in the United States has flowed through very, very nicely, but it will still remain positive. And I think that's critical. The way you value any business is based on the corporate profits generated by that institution. And positive earnings growth year over year, we've gone through an extraordinary cycle since 2000. In the US in particular, with only 2 years of down earnings growth and one flat year, but 18, 19 years of historically new high profit pool. And we think that that should continue into next year, which should provide valuation support for equities. That said, we are an elongated cycle, certainly getting longer and longer in the tooth, and somewhere out there is a downturn. But as I said earlier, I think it's a ways off.